Thanks, everybody. Who went to the party last night? Was it fun? Okay, good. So it's day 3, and day 3, we do have some great CEOs and CROs and others, but it's traditionally been Money Day. We have like hundreds of brain dates with VCs, and so much has changed that I wanted to invite someone that has truly seen it all to help us learn about it.
Helps to be so old.
Seen it all, but really seen it all with Aileen Lee. And for a little bit of context, the world's changed so much, right, in the last 2 years.
Just this morning, actually.
Today we're going to talk about it. When I started investing in 2013, I think Aileen reached out to me to meet. I knew nothing. I didn't know what like an emerging fund was, what was going on, and we met. And Aileen was truly a pioneer. Cowboy Ventures, now there's hundreds of seed funds, right? This is 500, 600 Shy Goldman. But probably you, Homebrew, a few others were like the first group that created a real seed fund, right? In 2012 or something like that?
I will give, so we started in 2012. Yeah. I will give credit to first round, Josh Kaufman and those folks.
Yeah.
Steve Anderson at Baseline, Harrison Metal, Michael Deering, Chris Sacco was angel investing. Like I was at Kleiner, because I started at Kleiner at the end of 99. And the seed thing was happening in like the mid 2000s, like 05, like that's when we really should have started, by the way.
Yeah.
And angel investors were getting in at 3 pre, 4 pre, and they were all co-investing. And then as a Series A investor, I was kind of running around. I was already friends with a lot of those folks, and I was just constantly trying to figure out what they were investing in so I could get a chance to look at it for the A. And I mean, at Kleiner, I never really knew any of our, what we call LPs, which are the investors in our funds. We never had an LP meeting in the 12 years that I was there. So it was actually those guys who I called and said, hey, I'm thinking about starting a seed fund. What do you think? Is it too crowded? Isn't that funny?
Yeah. The answer probably was yes.
They were like, no, it's not. Like, the fact that you've been an A investor is really different. There's also, you're a woman. There's no women. So that would be different. Come join us. And they introduced me to my first LPs.
Oh, that's good. That's
yeah.
Good. Yeah. So we'll talk through what's changed and what's changing. A pioneer there, a pioneer in sort of institutionalizing that, and then we'll dig into the market, and then a pioneer really helping all of us think about how the markets will change. And we're coming up on the 10th anniversary. We were just talking about backstage of Aileen's unicorn post on TechCrunch. A lot of you probably never read it, but when I read it, there's a couple things where my jaw dropped. And it was the first time we'd really seen data around startups and what it takes to get to $1 billion, and how many were solo founders, and that what age there were, and all the pieces. And there were 2 of them that were sort of canonical. So that inspired us. And then I'll tell just a quick story, and then I do want to dig in. And then when I started investing for real, it was great that we'd met, and it was friggin' crazy in 2013. I felt like I wrote this, and I got a little trouble. I said, I felt like it's Mad Men. I felt like I had walked back in time. I couldn't believe it. I mean, 2013, not everything's changed, but it is a long time ago, right?
Yeah.
But I literally working on Sand Hill with the beige-colored furniture, and just room full of not just dudes, but like the whole patronizing view of venture capital. I felt like I was literally on Mad Men, right? And
yeah,
then
a lot of when you walked into VC offices, there's an extremely attractive receptionist, and then a bunch of guys in offices, and it really did. It was like Mad Men. Yeah, just different clothes.
So just just the whole, even before All Raise, and I don't want to spend all our time, it's just such an inspiration to me to see a change agent, and I just felt so inspired by it because I couldn't believe it. And I had this one moment, and then I'll stop, and I just, not only was it all dudes, but I went to this one pitch. It must have been early 14. And it wasn't just the partners and the associates. For some reason, there were like venture partners, venture friends, venture buddies. It was like 28 dudes, and the air condition broke. And there's this poor woman CEO pitching. And I don't know why she was uncomfortable. She might have been comfortable because it was 98 degrees. She might have been comfortable because pitching's hard. But watching her stand in front of this room with and I'm like, this is just the worst industry. This is just terrible.
I would like to give you a giant shout out, because the SaaStr community, and like you demonstrate, like we know that to make the change, the CEO has to be committed and the leader has to be committed. And I just feel like the commitment you've made at SaaStr to make sure that every panel, every stage, the mix of the audience is diverse, and you do a huge. So I would like to give you that. It's like really, it's like you were one of the first big communities to be like, no manels. We're never gonna have a manel. I mean, I don't, it's kind of crazy that not everyone is like that still, but you really were the first.
I mean, I want to talk about the industry in general, but I'll, you know, it's if you want my learning for what it's worth is, we did the 2015 annual, and it's like a startup. So I decided we wanted to do one. I had 30 days to get 1,000 people. So what do? You call your friends. Mm-hmm. Not really my friends. Aaron Levy, will you please come? Right? A few other folks, and then I'm like, Slack seems hot. Stuart Butterfield, will you come? And I turn around, and I'm like, oh my God, it's all dudes. Mm-hmm. I mean, it's the terrible thing that happens with startups, right?
Yeah.
It's not always intentional. And all of a sudden after that, first year, I'm like, okay, we have to be, if we're going to do nothing else, we got to set this as a goal. We have to have at least 50% women, right? And but even it's terrible to realize that I should have been aware of it in 60 seconds, but I wasn't. With one, I'm just, oh my God, how do I get people to come? Like I gotta get the party together, right?
You've done an amazing job.
But it's the same problem with founders. It gets to be too late, right? If everyone's like you, there's a moment where it's too late. So anyhow, we can chat about that.
It's never too late. It's never too late.
It's never too. It isn't. This is an example. There's a ton of VCs speaking. This will be one of the best sessions, but we've got Benchmark, Lightspeed, and Andreessen. After this is State of the Cloud with Bessemer that we know well. We've done that like 5 years here. It's going to be pretty cool with a lot of data. So come to all of these. But anyhow, I wanted to just briefly talk about this slide, which is Figma. I know we can't quite see it, but we have a lot of content in here about how the markets are down and the markets are challenging.
I think it's really cool how they arranged the announcement to make sure that it happened during the SaaStr.
Did everybody see this morning?
Well done.
Okay. Did anybody raise the price of a discussion you're having with the VC here today as a result? Anyone up the valuation? Anyone feel more confident? A little bit?
100x is back, baby.
Yeah. So I know we're processing it, but there's been a lot of negativity in venture the last couple months, right? How does it change what you think?
Well, I wouldn't say negativity, but obviously, like, prices have, I mean, obviously the public market is the tail that it wags the private market dog, right? And so, and it's interest rates, right? And also, like, the pandemic, like, you know, we pumped a lot of money into the economy during the pandemic. We bought a lot of software during the pandemic. You saw things like Zoom go crazy. And then everyone's like, oh, I'm just like Zoom. I also should be able to grow at that rate and trade at that multiple, right? Yes. And that was like a false assumption, I think. And I think it's kind of crazy now looking back at it that we didn't think, oh, this is a pandemic bubble in some ways, but clearly there was just a lot of stuff that is not going to be like it was a year and a half ago. And so, yeah, I mean, I think every venture investor, if you, like, raise your hand if you're a founder or if you're a CEO. Okay. Raise your hand if you have a board. Okay. So we're going to dish a little bit on, like, what's going on behind the smiles at your board meeting. Because a lot of people are sitting on super overvalued investments. And depending on what price they paid and what's in their portfolio, they are super stressed out right now because they don't see a path for their portfolio companies or a chunk of their portfolio companies to grow into the last round valuation. And so I think that is, and they're probably pretending that everything's fine.
Yeah.
So when they see you, they like high five you and like, what's up, man? And like, but inside they're like super stressed out and they're not sleeping.
Now, but of course, VCs have multiple bets.
Yes.
You know, this is the classic dichotomy. I only get one bet, and my VCs in Jackson Hole or wherever in Europe, they get to make 20 or 30 bets. Why are they stressed? Because they've got a Figma in their portfolio. Why are they stressed?
I mean, Figma is well, we were talking about this earlier, right? Like, I mean, it is the thing that you want as a venture investor, right? It's the one thing that's going to drive your entire portfolio. And I think there are a lot of really interesting lessons about that story, right? One is, like, for the first 4 years of Figma, maybe the first 5, people really laughed at it and looked at the venture investors and this company that had not shipped a product for 2 years. And then they shipped a product and no one was really using it and people said it sucked. And then they basically like shipped another release and everyone said it sucked and laughed at the venture investors and the people working there being like, they're chasing a windmill. This is never going to turn into anything.
Yeah.
And so even though when you look back at it, I think it's probably like a 8-year-old company, 10-year-old company. So getting to $20 billion in that period of time seems pretty fast. But the first 4 or 5 years was pretty slow. And that gives, hopefully, like, if you are working hard at something that you have a big vision for and it's not all going your way, you should know that not all $20 billion exits are up and to the right the entire time.
Yeah, I think Figma, I knew less about Figma than then maybe I should have. But I was looking it up this morning. I think it was 2012 to 2016 until a full GA.
Yeah, right. Okay,
right?
so it's a 10-year-old company. Yeah.
And then 2016 to 2022, they went to 20 billion.
Yeah.
So that, and we were talking about Notion. Notion was here. The CEO was here yesterday.
Mm-hmm.
I think they were 5 or 6 years until they had any real revenue at Notion, and now Notion dominates, right? And
no, I think that is obviously that's something we'll talk about, which is PLG.
Yeah.
Right? And like depends on who your customer is and how your product gets adopted. If you can have self-serve and you don't have to spend any money on AEs or customer acquisition, then you can spend a lot of time building the product and then it'll fly off the shelves. If you have a product that has to be sold, it's a lot harder to wait for 4 years.
Yep. So let's just, but the Figma thing, we didn't talk about before, but it's so interesting. When, as a seed investor yourself, when's a startup been at it too long? When do you, like, you'll meet with the founder and they'll be out here, I've been doing this for 5 years, I'm finally at $1 million in revenue.
Yeah.
When do you lean in? And when are you like, well, it's just, it's a sign that like, you're never really going to get there? When do you decide?
Yeah.
What's like the oldest startup you invested in? Do you know?
Oh my gosh.
You think? Have you done one that took 5 or 6 years to get a seed check?
No.
No.
No. I would say at Cowboy, our specialty is probably more pre-product risk. So most of the time, like more than probably 60% of the investments we've made in the past 10 years are founders who need money to build the product.
Okay, you didn't have any that took 4 years then?
No, they're like, we have this idea, we've built wireframes, we've done some landing page testing, we've done 20 customer interviews and customer discovery, but we come from humble means. I don't have a giant bank account, I need the money to hire the engineers and build the product.
Yes.
And so the risk that we take is often like, are they going to be able to build something like they say they are, and is there going to be a there when we actually ship it?
Got it.
But no, I don't know. What about you? Do you have anything that's 4 or 5 years?
No, but maybe sometimes you don't know the history of the company. For example, like, so on paper, my best investment is TalkDesk we were talking about last year, and I thought. It's interesting, the history. When you look at the history that I was aware of when I met Tiago in 2014 was it took him a year to go from like 0 to 2, and then another year to go from 2 to 15. Okay, that was what I knew. When he came to SaaStr Europe in Paris, he's like, you didn't know I babysat for 2 years before that. I was the first time founder from Lisbon with nothing, and I came by myself and back and forth, and so sometimes there's a prehistory.
Yeah.
And maybe as founders, it's good to market yourself properly with what's your or I had an agency like MailChimp from yesterday.
Yeah.
Sometimes there is that, or we were working on it. And sometimes you can kind of pick your day one sometimes, can't you?
Yeah, totally. Like, if you look at Figma today, it looks like they started in 2014.
Yeah, and some will even say 2014, 2016, they'll do some of these. So I want to go on to the next point, but to wrap this up, is this, I know we're processing in real time, do you think this will create more optimism, especially in growth and later stage? Doesn't it almost have to create a little bit more optimism?
Like, I think it's, yes. This is what we all aspire to, right? A lot of founders and investors aspire to this. And you just gotta, you gotta pick an industry that ideally has a non-cloud native incumbent that is worth a ton of money, right? Like he had an incumbent that had a $100 billion market cap that has, 40% EBITDA? It's like an incredibly profitable segment to be in, and they're not a cloud native company, right? They've tried really hard to get into cloud, but they have this massive open flank of a competitor that's cloud native that is beloved. So if you can pick, there's tons, that's another thing we do all the time at Cowboy is we analyze, like, what categories have really old, slow-moving incumbents where people don't really like the product? That's a great place to build new software.
It is, yeah. Interesting. So, but do you think that this will lead to a few percentage points more optimism, or you don't think so?
No, because you still look at Snowflake and Datadog and all the companies we talk about, right? Like, best-in-class companies now that have a clear path to profitability, they have really good margins, they're trading at 15 times revenues.
If they're lucky.
Right? If they're lucky.
The PagerDuties and boxes are 3 or 4 times revenue.
And so, that is the bizarre, unfortunate reality for some this year is last year people were able to raise 100 times revenues, right? This year, best-in-class SaaS companies with great margins and great ACVs and great NDR are trading at 10 times revenues. So the old adage of build your product with your seed, get to a $1 to $2 million in revenue, and then raise your A. If you can do that, last year you would have raised at 60, 80 pre, you would have raised a $20 million Series A and be at 100 post, right? But 100 posts at a $1 million revenue would make you like your valuation 100 times revenue. That's just not going to happen, unless you have a ridiculous story to tell. Maybe you were like VP of engineering at Stripe, or like, you know, those people will still probably raise at high valuations. But for us regular people, I think Series A's are going to be back to $8 to $12 million, and Series A valuations will be back to 20 to 35, 40 pre.
Yeah.
And B's will be back to 100 pre instead of 400 or 500 pre.
Let's unpack that just a little bit.
Sorry.
For seed, no, it's great insights. For seed, if you had to distill it all, all the market changes, how much lower do you think a typical good seed deal is today versus 6 to 9 months ago? Today we're still adjusting, right? Like right now we're seeing a lot of seed extensions. We're seeing a lot of seed founders who are sending us decks that have a $6 million seed raise in them. And I'll email the founder and be like, hey, this looks really interesting. Are you still thinking about a $6 million seed? And they'll be like, oh, no, sorry, that's a mistake. We're raising 3. So we're still adjusting. And I think that that's going to be the rest of this year. Got it. Okay. Are you seeing the same thing? I don't know. I think let's spend some time going through the stack of letters for the round. Yeah. I think you're right. I think the other point you made in some notes to me was the weird effects of overhangs, the weird effects of founder-led funds, founders that have 100, 200 million of their own money to deploy, and the confidence of a lot of folks in the next Figma being relatively valuation. I mean, I wish I had the data from this YC class. I'm sure it's down, but I bet it's pretty good. I bet the valuation, I bet there are plenty of people that were thrilled to write 20 million post-safes in very risky early stage and have no qualms, right? No qualms at all. I do think some of that speaks to like what we called, like we derided them as tourist VCs. And that's not very respectful, so I won't use that term. But I think there are a lot of people who have not seen cycles before in the industry right now. There's a lot of, like, basically, as these funds got bigger, they had more fee income. And so they could feed more mouths. And they would hire younger people and say, you have a checkbook. Like, you don't have a big checkbook like I have. Like, you know, the general partners could write 20, 50, 100, $150 million checks. The younger people are given checkbooks to write a $2 million check, a $4 million check. That way, if they don't work out and you let them go, you're not actually losing that much money. And it's kind of like training wheels for the next generation investors. And so a lot of those folks have not seen cycles. They only understand the world we've lived in for the past 3 to 5 years. And so for them, going from a seed that was at 50 posts to a seed that's at 25 posts is like, cool, it's like a bargain. But they don't realize that things are still going down. And so I think we're still in this adjustment period. Yeah. I think we were talking about, I think most founders are through this. And again, being funded at all is a luxury and a privilege in many ways. Yes. For folks. There's many bootstrap folks here who get to millions without it. I think founders were slow to adjust to the change. They've been slow, and I think and I think the biggest risk is the next round. Right? What if the next round went from, because last year in 2021, everyone assumed the next round was coming. It's not just that it was at 5x in 12 months or 100x, it's that it seemed so de-risked, didn't it? Everything seemed de-risked out of the system, didn't it? Yeah, we were joking this morning. So I'll raise this nonprofit that I work with, and I'm in this cohort with other investors, and I was telling them I was coming here, and I was saying how, like, I feel like in the last downturn in the recession in 2008, we talked about how flat is the new up. And I was like, is flat the new up? And we were like, no, any money is the new up. Next rounds are going to be hard. Yeah. And I think some people are not going to be able to raise them. And what's your just general advice for, and I think you put some notes about talking to your investors, talking to board members. How do you find that out as a founder? How do you know if in today's world you're fundable? How can you just, because we just want to know the answer. Yeah. Like, where do I sit in September 2022 or whenever people watch this? That kind of speaks also, like, I've always been a big fan of an engaged board. Yeah.
And the past 5 years, we've gone through this cycle where it's like, you don't need a board, or just like get easy money, or like, and VCs have been chasing all of you, and it's been super competitive. Like, it's been a founder-dominated market. So a lot of investors have gotten scared to have real talk with founders because they're afraid the founder's not going to like it, and then the founder's going to shit talk them behind their back, and then be like, oh yeah, you don't want Jason or Aileen at your cap table. They're a total pain in my ass. And so then founders got really like used to just, funders got really used to just blowing smoke at founders because that's what founders wanted to hear. Like, not the hard stuff, not the stuff that we need to work on, or where you have a blind spot, or where you're deluding yourself, and also a lot of the less experienced investors, they haven't been through this before. So if you have a board, if you don't have a board, I would get a board. If you do have a board and people are not giving you the straight talk, ask them for it and tell them that you want it. And if they don't know it, like, they may have colleagues who've lived through. Also, I think independent board members and outside board members are totally underutilized by boards. Like, get someone, if go-to-market is your big risk, get a great person who's got go-to-market experience on your board, who's lived through cycles and understands how budgets tighten, how sales cycles slow, how cash gets pushed out, and like how you do collections, all the ticky-tacky stuff that you gotta live through the hard way. I think that's the way you get because you have to come up with your battle plan.
Yep. And just, I know this almost sounds like a silly question I've asked years ago, but today, if people aren't having board meetings or investor meetings, how often should they have them?
Oh yeah, actually you made some good comments about how you're seeing a lot of sloppy board behavior recently, right?
I'll give you one company I invest in. It's doing well.
Yeah.
It has like a really fancy venture fund in it, but the partner lives at the beach now. It has another really good fund, but it's run by a CEO. Mm-hmm. The last board meeting was 4 months ago. The next one hasn't been scheduled. They don't care. I mean, they've done well. One's running a unicorn, and one is a very successful VC who probably did too many investments. Yeah. Right? And so nothing's scheduled.
It's well, the other thing to add to this dynamic is that investors, LPs in venture funds, have basically put on the brakes. And so any fund that is trying to raise right now is having a pretty hard time for the most part. And they're not going to tell you they're having a hard time raising money or that they're going through a grueling fundraise. But that does play into their dynamic of how they communicate with you because they need you, the founder, to be a reference for them. And so we have one portfolio company where we're off plan and it doesn't feel like the velocity of shipping is not at the place where it should be. And I'm not on the board, I'm an observer, and someone else is on the board. And I called the board member and I was like, hey, what's your feeling about how this, what kind of coaching are you giving the team about how things are going? It feels like things are off and we are not doing the things we should be doing. And he was like, I gotta be honest. I'm raising a fund right now and I cannot afford to have a bad reference from these people. So I'm not telling them anything. That is not the job of the board member. That made me really pissed off.
I had not thought through that VC's own investors, their LPs, would be a cause of this overly saccharine approach to founders, right? It's so, when we started, when I was a founder, I thought VCs are the most patronizing people I ever met. They would condescend to me, young Jason, no matter how old I was, young Jason, this is how you do it. The jacket preparing for months for the board meetings. And now everyone smiles. I missed the quarter. Great, Bob, keep going. We actually had no sales last month. Okay, keep at it. Keep at it, kiddo. And I'm trying to figure out what the hell's going on. I get more, as time goes on, I get more direct. I get more empathetic, but actually, I don't have time to do, hey, kiddo. I'm like, look, guys, you're fucking up. Just change, right? But I thought it was more just general reputation. But maybe it's helping. Maybe they're worried that their own investors will call.
I think it's both.
And not get all the check boxes, and they'll go with Cowboy instead of somebody else, right?
I think it's both. Yeah,
and it's not to get too niche. Maybe we're back in a world. It seemed like this went away where actually VCs are competing with each other again for LP money, right? Does that exist today, or is that from the old days?
Yeah. Well, I mean, I think it's not. But yeah, the LPs, the LPs. I don't want to go too much into the LP side, but it's really interesting because let's say if you had $100 and you're an LP. Right? You're going to say, I'm going to take 10 of it and put it in real estate, 15 of it and put it in debt. You want to have a diversified portfolio, right? And I'm going to take 20 of it and put it in private equity and venture capital. Maybe 10 in venture capital and 10 in private equity. I'm going to have, like, let's say 40 in stock, right? And you always want to have this balance of your holdings. Well, stock, let's say if you had $40 of your stock, of your $100 in stock, and the market has contracted. So now your $40 is worth $20 in stock. And so it throws off your whole portfolio. And so your venture allocation, which was already potentially overvalued because you were sitting on these really expensive private unicorns and all these like undistributed public stocks, it now looks like a bigger chunk of your portfolio than it used to. So it means you don't want to overspend your budget. You said you only wanted to have $20 in venture, but now as a percentage of your portfolio, it's like 30% of your portfolio.
Yes.
So they're having to kind of like restrict themselves in the first place. So it's just a really funky domino effect.
I think that's the thing for founders don't need to know everything.
You don't, yeah,
but
exactly.
it's worth knowing two things. Almost all VCs have their own VCs called LPs.
Yes.
They have their own VCs they have to report to, and it's actually worse because the LPs only view you as a number. I remember the first LP meeting I had, it was like JP Morgan Chase or something. We went into this meeting and he just flipped to the last page of a 90-page deck and just looked at the numbers. He walked in, he says, "Are you guys IT or healthcare?"
Totally.
IT?
Yeah, totally.
We're
basically like
not good enough. We're looking for top decile. You guys he just ended the meeting.
I mean, all of us are basically like stocks in their mind.
The stocks, weird stocks, really weird stocks, right? And so I guess it's worth knowing they have their own investors, and it's worth knowing. You don't need to figure it out all because there's a lot of investors, but there are stressors, and the stressors will vary. Some are more stressed, some are less stressed, but there's stress in the system beyond valuations that didn't exist a year ago, like the stress, right? And the other one that I wonder, not to go off on a tangent, but you have so much better data, or at least historically, but do you know what the average top-tier university endowment and venture did last year? The IRR?
Last year was incredible.
90%.
Yeah.
So I actually think it's not just the denominator, numerator. I actually think LPs believed they were as brilliant as the VCs believed they were. I think LPs thought everyone thought this world would last, didn't they? For longer than it did.
I don't know if we thought it. We hoped it would.
Hoped it would?
That's different. I mean, if you look at, like, you're going to do the Bessemer Cloud Talk, right?
Yeah.
You're going to look at, like, where are we? And it seems like, in all likelihood, the multiples of last year were just an outlier.
Okay.
And
so then why'd they do all these investments, these VCs? Why'd they do all these
Because it's such a good way to
rounds?
make money. I mean, people made money, right?
Yeah.
Look, it all is not lost in any way. Like, software is an incredible business, and software is an incredible enabler, and it's only going to go fast. I mean, the pandemic unleashed so much more opportunity for software. I mean, obviously, unleashed so much pain, and is still, so many people are enduring from the pain. But like healthcare, GovTech, EdTech, SaaS, back office processes, what's going on in AI. I mean, what we need in security, what we need in, like, how PLG has changed, what we need, new CRM. It's an incredible business, so I'm glad we're all in software.
What do you, just to go back to an earlier point, I've been meaning to write the SaaStr blog post that I haven't written, but it's something like either 2021 was the year SaaS got easy, or 2022 was the year it wasn't easy anymore. And what I mean by that, it's never easy, right? There's 200 sponsors here, but in the old days, which is like through maybe 2018, in the back of your mind, you're like, to raise it $1 billion, I need to get to 100 million in revenue.
Yeah.
And that creates a series of pressures, right? Because you talked about a Series B going back to 100 million. I mean, the amount of pressures. So let's just go back. If C is murky, but you think to raise a B, so your third round of capital, instead of being at 400 or 500 million, might be at 100 million, 200 million. So what sort of compression amounts you raise? Like, what does that mean? What do you think or since you're writing the New Yorker, what do you think a real unicorn needs to be next year? What do you think a unicorn is going to look like in 2023?
I mean, I still think, I know there's been a lot of, like, there's too many unicorns. I still have always said this, like, I think building a $1 billion company is incredibly hard and incredibly special.
Yes. It didn't feel that way last year, did it?
It's still not. I mean, even the people who are running the companies that are worth 5 or 10 would not tell you that it's easy, right? It's crazy stressful. You have to be really lucky. a lot of things have to break your way. And so I guess we're going back to that place where there's going to be less unicorns every year. I do think next year, like when we did the original unicorn analysis, we looked at kind of vintage birth years and like what were the best years to start or found a unicorn, and generally downturn years are the best years. I think just, you got to be more committed to your idea. It's going to be hard. It's not a get-rich-quick path. And so I think that is kind of imbued in the culture of the company and in the hustle and the scrappiness of everything you do. So I do think next year is going to be, like from a venture perspective, for us, next year is going to be an incredible vintage year.
Okay, two things I want to hit.
Yeah.
If you guys want, I think we have time for 3 or 4 questions before the next session we do. So I'll try to go 5 more minutes and then get you guys some questions, so feel to join. But just a couple, one maybe slightly fun point, and then I want to talk about the overall dry powder and overhang.
Okay.
But
I like that you made like 20 slides and we're about the first slide still.
Sometimes you never know where it goes on the 3rd day. We can get through them all if you want. Every VC today seems to be a discounted cash flow interest rate expert. I didn't hear anyone last year talking about interest rates in DCF. Do VCs even know what they're talking about? Like, I kind of want to like pull my hair out when I hear everyone all of a sudden saying rounds don't make sense at 300 million because interest rates are at 4.6%.
Yeah, it's a really funny, like, raise your hand if you understand like how interest rates and discounted cash flows impact SaaS valuations.
My arms stand down.
Okay, so yeah, it's funny. I've actually, over the past year, I've drafted this blog post like 5 different times, and it's just so hard to explain, or like, it's like, the writing is really boring. So basically, I was fortunate to start my first job after college. I was an analyst at Morgan Stanley in mergers and acquisitions. And so you're basically like a model jockey, and you learn how to use Excel really well. And so basically, you look at how much cash a company is going to make every year, and you take an interest rate, and then you kind of add stuff to it. So if the interest rate was 5%, that you might turn the discounted cash flow rate into 15%, let's say, right? And then you basically discount all the future cash flows back to today using the interest rate. And so let's say like $1,000 worth of cash in the future is worth $100 today, right? So what happened is, we used to, and still a lot of public company stocks in traditional markets trade on multiples of cash flow, right? And the best, on the P&L, the best proxy for that is EBITDA, or EBIT, okay? So what happened kind of in a weird subconscious way is because SaaS companies have such good margins, and when they get profitable, they do throw off so much cash, revenue kind of became a proxy for EBIT. And so we started looking at software companies on a multiple of revenue instead of a multiple of EBIT. And also because SaaS, the whole idea is like you invest a lot in the front, so you lose a lot of money but you make it all later. It was too hard to look at EBIT because people had so much above the line that they weren't generating good margins in the first, like for 5 years. So we moved to multiple of revenue as a proxy, basically, for like the future profitability of the company. And so when interest rates are 0, the discount rate is a lot lower against your future cash flows than when interest rates are where they are now and where they're probably going. And so basically that does impact how, like if we're lucky enough to be working at a company that becomes public, financial analysts and research analysts are going to cover your stock in terms of what are the margins of your business and how much cash you are generating as a company, because that is actually what they really care about.
Yeah.
Sorry, that was really long, but that's why it matters.
But did all of our brilliant VC friends, many of whom today, did they really think interest rates would be 0 forever when they were doing these rounds? I mean, I certainly thought it was a gift, right?
It's kind of like, there might be some analogies to Web3 and NFTs and crypto. Like, it was speculation, right? For the phase that it was really crazy.
It was speculation.
People were making tons of money.
Yes.
And so when things are going up, that's a good time. If you get in and out at the right times, you can make a lot.
Yeah. My sign of speculation in venture is when the pre-seed investors won't sell at $1 billion. The market's changed at the peak when, in the old days, when I started investing and met you, when I met some of the the original seed investors are like, you know what's great about being a seed or pre-seed investor?
You can get out.
Sell.
Yeah.
Like if you're Excel or Sequoia or Bessemer, you can't sell in the Series D. You actually have to put more money in. You have to support the company to $1 billion. But these valuations are so crazy that little Lemkin
we actually can do a favor for the founders because they want,
sell.
Like,
no
when
one
your
sold, did they?
round gets
no one
scarce.
sold. They raised opportunity funds and they invested at $1 billion instead of selling, right?
Well, that's why Sequoia went to this new fund structure, is because they did the analysis and they showed that by selling too early, they had left a lot on the table.
Yes.
It's going to be interesting to see how that plays out. They're very smart people, so I think they probably know what they're doing.
All right, last follow-up on this, and then we can definitely take some questions for a few minutes. And maybe I know we skipped a lot of our slides, but let me grab one as a prop. This one, okay?
Yeah.
Here's our revenue. We talked about revenue multiples. I probably should have thrown this slide up. I grabbed this from Bessemer, who's speaking next, but historical current revenue, not next 12 months, current multiples. And they're back. You don't have to see all of it, but we're basically back, depending on how you look at it, somewhere between 5 years ago. Possible reversion to the mean. Do you think, if we're in the middle, like it looked like we were going to do better, like multiples maybe weren't like crazy COVID, but do you think we'll come back to the middle and then venture's good, or do you think we're stuck back in the old days of multiples?
No, I don't think we're going to go back. I mean, I don't think we'll go back to like whatever the beginning of what the far left is. I think we'll end a little bit higher.
We'll
I think we will end a little bit higher. Yeah.
Yeah.
But I think I'm a hope for the best, plan for the worst person. So if we were working together, like we could hope that that's what's going to happen. But from a burn perspective, from a revenue, from a plan perspective, I would plan for things not to get better and make sure we can survive. And then if it winds up being better than that, we're in great shape.
But at some level, so I think that's what you've got to do as founders, and is plan for the current world.
Yeah.
Maybe not too much worse, but a little bit. But but deep down as an investor, you think we'll see some improvement in multiples over the coming 2 years.
Yeah, because I think the software industry becomes more sophisticated and more efficient, and the margins get better, and the companies get better run, and cloud and just like AI, like it's just going to put so much more leverage on the system versus like I mean, I know these are SaaS multiples, but like early SaaS was much more expensive than SaaS today.
It's true. All right, anyone got some questions you want to ask? You can try or come up to the mic if you've got one. Don't be shy.
Yeah. Did we talk about what you came to hear about? Like, if we didn't talk about what you wanted to hear, ask us a question about what you want to know.
What do you think companies
Can you stand up a little bit? It's hard to hear you. Yeah.
So maybe is the question that will investors actually even care about profitability? Is that the question?
Oh yeah, are you talking about gross margins or net margins?
We're not going so far that early stage investors care about profitability, are we?
No,
we haven't gone that far down the multiple hole, have we?
I think, like once you're past post Series B, that's when you're having the conversation about at your board, with your board and your investors, about path to profitability.
Yeah.
I would say for like seed and A, I think seed is about ship your product and get to product market fit, right? And start to get a sense of what the margins of your business are, who your target, like who's your ICP, and do they love it, right? And then A is really like, can you get from, let's say, from post seed, let's say if you're at $1.5 million or $2 million when you raise your A, then you probably need to get to between 5 and 10 in revenue during your A, which is a change from where we were. And it gets harder every phase in different ways. But I do think the fundamental gross margins of your business, people are going to ask you earlier than they used to. And then, how much you are spending on, and there's so much we can talk about. Like, I think customer success, customer support, like that, there's still so much opportunity in that. I think we have some good software, but there's still a lot of opportunity to build a lot better software for kind of like not just the sell in. Like I feel like we've had a glut of sales tools in the past 5 years to help you sell in, and there's going to be a lot of opportunity to help you sell through that everyone's going to focus on, because it's just much more efficient to work on land and expand and keeping your customers than going to get new ones.
Let me maybe just spin a version of the question on margin. Yeah. For your top investments, the top ones that are also very well funded, that have years of runway, is there pressure to be more capital efficient today, to not spend it, or does for that elite, like growing like a weed and well funded, do all this talk about profitability and sales and marketing efficiency, and has anything really changed for those ones?
Like I think last year, so like yesterday, I don't know if any of you went to the Drata talk yesterday. They're going like crazy, and the product is amazing.
Yeah, any pressure there?
One of our portfolio companies, Mutiny, is here, and they have a booth, and they're going like crazy, and they did a big round last year. And I think they're great. They're in good shape because they've raised a bunch. They've got years of runway. The margins are good. Customers love the product. But yeah, I mean, it's not as like right now, if a year ago you might have had a conversation about should we grow 5x or 10x next year, right? And that was really the conversation of why wouldn't you grow 10? Like do it, why wouldn't you, right? Yep. And right now the conversation would be like, well, tell us the trade-offs of how much do we lose if we grow 5x versus 8x versus 10x, and what are the margins, and who will you be signing, and what's the retention going to look like, and like, what's your revenue quality? I think that's a conversation. I think that's an important point on the topic. It's like a year ago, maybe no one asked any questions. They didn't care what your gross margins were. They didn't care if you were 10% or 90%. Yeah. Just grow as much. Now, if you're a top tier, they want you to grow, but they do want to know the quality of revenue, right? Yeah. But I think, and then just where I think founders maybe get bad advice on the internet is that profitability is so in fashion that somehow lower growth is better. That like now, if you're at 2 million growing 40% but profitable, it doesn't make it an attractive investment in this climate, does it? It's still hard. Because you have to have both now. Yeah, you have to actually have more of a full package. Totally. Today, don't you? It's not like, don't worry about growth. That is bad advice. Yes. Growth is still very important. Yeah, there's extreme. So anyhow, that's just where I think profitability, people just want efficient growth today. There's tons of venture capital, isn't there? But it's just inefficient growth is reserved for a tiny elite. Versus last year, inefficient growth was available to many. Yeah, that's another thing, I guess, about the VC dynamic is like there is a ton of venture money. Like there's a ton of dry powder sitting on the sidelines. Yep. And it's almost like everyone went to a really big party, they drank way too much, and they have a hangover, so they woke up and they're like, okay, I should not drink for at least a couple days. Like basically that's 2022. And so they'll be back. It's just that, but I think raising right now, if you can't avoid it, because people may be also trying to kind of cost average down their portfolios. Like they paid too much, and so let me underpay now, so I kind of wind up in the middle. And so like if you raise now, if you can avoid it, you're going to be getting a lot of bottom fishers who can afford to sit and wait a little bit and kind of reassess and see where things settle out and then get back into the market. Good point. We probably have time. We can do 2 more questions. Anybody else have one that we want to ask? Oh, go ahead. With microphone. We'll try to do 3 if we can. Yeah.
So I had a question around how to properly do valuations for different verticals and growth rates, because I keep seeing like that chart where everyone's just like, no, now it's 5x. This is it. But we're growing really fast. We're enterprise. We're big data. We're all these things that I think should add to valuation. So how do we properly factor those to make sure we're getting a fair price? Well, it's not, I mean, you have to go to market, first of all, but it's not 5x. Like, look, if you are raising a Series A and you're doing $2 million in revenue, generally, you are not going to be raising at 10 pre. That's not happening. So there is a private premium for sure. But I think you've got to go to market and see what the market tells you. That's usually the best way to do it. So almost create a bidding war of sorts? Well, as investors, we hope you do not. But here's the thing. But yes, you gotta test them. When we work with portfolio companies, we'll often tell them to kind of go off Broadway first. Like, you practice your pitch,
right, with people who you don't think are a good fit or unlikely to be the people that you want to work with. Because the more times you give the pitch, the better you get at it. But you also then get feedback on what the questions are and like what people are thinking in terms of valuation. And then you kind of do your Broadway pitch.
And my view, for what it's worth, I'd be curious your thoughts, is no matter what happened last year, I think all the time I've been in SaaS, including the founder, there's been an anchor valuation, which is 10x ARR. Okay? Now it's gone up, okay, and maybe that was 20x during the peak. But at the end of the day, if you're fundable but you're not quite at the elite level, you might fall to 5x so that someone will take the risk. Okay?
Do you think that like a company doing $2 million in revenue is going to raise at 10 pre?
No, at 20.
10x. Sorry, a 10x, sorry.
I think that is, if you're not in the bubble, if you're not from YC, if you don't have elite founders, I do think for my whole career that's been an anchor point. And you can anchor up based on, you know, oh, hey, I was head of marketing at Gusto, I was this, I was that, you anchor up. Or you might anchor down. No one's heard of me, I'm self-taught. I have no pedigree, fancy pedigrees, and you may get a discount. But I still think that in today's world, I think it's good to go back to that and then just look, if you hit that, in venture, the math pencils out for everybody, and if you get more, great, and you may come up short, and that's a lesson that you're not hot, you're not checking these boxes,
As we said, for the next 12 months, any money is the new up, basically. So I do think, but I also think there's an element of like, how much do you want to raise, and how much dilution are you willing to take, and how much does the investor want to own? Like, that's part of the calculus as well.
Yes.
Where the owner, like, they don't want you to sell 60% of your company in a round, right? That's not going to give you the right incentives. And they probably don't want to own 40% of your company. So, like, that also helps push the valuations up.
Can I? My question is, I love the comment about the old, slow incumbent. About your product thesis. And my question is, like, how do you break down the industry problem in your thesis, in your method? And if you do build together an idea problem with second-time founders?
So the first one is, how do you break down like that there is an old, lazy incumbent that's worth a lot of money? I mean, put it in your pitch, right? Which is like, here's the product that people currently use. This is what they say about it. This is how much the company is worth. This is their margins, especially if it's a public company, right? It's got an old UX. It wasn't built for the cloud. It doesn't work well on mobile. It's super latent. Like that's, and like NPS of the product or reviews on the G2 crowd or crap, right? So put that into your story.
Okay. And the second-time founder, if you build together, like you analyze the industry, find a big problem idea, big second-time founder, and do together with them?
What's the power of a second-time founder? Is that
second-time founder?
Like, would we invest in them?
If you build a company together.
Great. I mean, yeah, I think it was funny. We were talking about this 10-year unicorn analysis because when I did the original unicorn analysis, I had this like crazy spreadsheet of like, where did the people work before? How old were they? What was their job before? Where did they go to school? I even looked at like birth order and star signs. Like I was trying to figure out like all kinds of crazy stuff. And one of the things that in the original unicorn analysis, one of the things that most of the founders had in common is they were serial entrepreneurs. Okay. But it could have been like in high school, I started a lawn mowing service, and then I was like babysitting on the side while I was doing my first company that failed and my second company failed. Like there was a lot of failure or like not big hit outcomes in people's pasts. But it showed that they just had the drive and the hustle and the entrepreneurial spirit. I think that's like, I tell my kids that all the time. I'm like, look, like, you know, you're juniors in high school. You should start something. It's really fun being my kid, as you can tell.
I think I think that's such a good point. I think that, look, there are VCs that love second-time founders.
Yeah.
They're like, even me, like my first startup I sold for $50 million after 12 months, so all my investors gave me another check, right? That's how you do it, right? And the price went up, right? But not everyone likes that because sometimes they spend all the money and there's pros and cons, but Aileen's point's great. Most of you are a second-time entrepreneur in some sense.
Yes,
we all want to hear that. It's not just the dumbfounding story about Pez. We want to hear how you've been working on this problem for years, and whether it was truly you exited for $20 billion, or it was just something you worked on as a side hustle, or you worked on it somewhere else. We want to hear that you have 3 to 4 years of domain expertise, and even if it's an entrepreneur or something, that's what's very compelling to investors. So find that.
I know we're running out of time, but one of my biggest shadow portfolio misses is I brought Jack Dorsey in for the Series A of Square at my former firm.
Wow.
And he had been fired from Twitter. And the references, like, we did very comprehensive memos. I had a binder, a diligence binder, and the references were like, this guy is untouchable. Why would you, he is unhireable. Why would you ever consider working with him? He's a disaster, he's a nightmare. And so I got shot down. I think about that all the time, that I should have done a better, I should have figured out how to get us, and then I brought him back for the B and we passed again. So that was a big miss, not investing in Square. Now, the caveat to that is, like, white guys get second chances all the time. And so if you're hiring people and if you're building your company, just make sure that you are giving everybody a second chance, just not just certain people.
All right, last question.
Awesome. So my business, it's like a marketplace where I'm connecting startups and small businesses with flex sales talents. I've been doing this for the last year. We've done around 600 grand from a GMV perspective. Specifically, when it comes to marketplaces, what are some of those key metrics that you're looking at that pre-seed or the seed stage?
Do you know? I'm not a marketplace expert, for you anyway, but
well, for
marketplaces,
I'd like to know. There's a pH balance, right? You have to figure out, like, what's the rate limiter, what's harder? Is it supply side or is it demand side? So being able to articulate, like, what's harder? Is it harder to acquire on the sell side or on the buy side? And then figuring that out, like, what starts the virtuous cycle? How much does it cost you? And what have you figured out to unlock the virtuous cycle is really important, because getting that going is the hardest part of marketplaces.
Yep.
Thank you.
Sure.
The only small follow-on and then we'll break is just, if you're talking to real SaaS people, just know your investor. Like, I don't know I've invested in companies with GMV, and I don't know what they are, and I don't know how it works, and I'll never know. You have a broader background, you'll understand it, but, like, I only want to know your ARR.
I'm an omnivore, so you definitely,
right?
you have some random, there's no TAM, definitely call me.
So know thy investor. But all right, let's thank Aileen.
Thank you so much
this was really
for
great.
coming.
Thanks,
It's
everybody.
always so fun. Thank you.